Welcome to the Capital Spotlight. Today we have Taylor Coe with JCR Capital. Thanks for coming on the show.
Yeah, thanks for having me. Appreciate it.
So for starters, let's just talk about JCR, what you guys do, the various platforms you guys run.
Sure. So JCR is a middle market commercial real estate finance shop. We were founded in 2006 by Jay Rollins and Maren Steinberg, who have been kind of middle market operators throughout their whole careers. So they founded the shop really with the vision of being kind of a one-stop shop for middle market sponsors. So the vision has always been, we do a bunch of different parts of the capital stack, not necessarily in the same deal, but wherever the kind of ask is relative to the sponsor and where we think the opportunity is in the stack. The idea is we have a bucket of capital that fits that. So we do everything from stabilized perm lending, bridge lending, mezz, pref with participation, and then all the way up to your kind of traditional 90-10 common equity. So we manage a series of discretionary equity funds out of which we make the mezz, pref, and JV equity investments, and then we have a series of kind of separately managed accounts with several different insurance companies whose balance sheets we write the perm and bridge loans on. So a bunch of different pockets of capital we can draw on to kind of capitalize on opportunities as we see them come in. So that's kind of the vision. We are in the midst of raising our fifth fund, and we'll be moving on to the next one shortly here this summer. So definitely an exciting dynamic time to be in the market, as I'm sure everyone listening knows. And yeah, we're just looking for good opportunities and real estate we like at a basis we like with partners we like. So it's a fun place to be where we can kind of do a bunch of different stuff structurally to get into deals we like.
Yeah, great overview. So in terms of raising the new fund, sounds like you guys are optimistic about potential new exciting opportunities coming up in the market. And obviously JCR has a history of special situations, investments, and things like that. Do you want to talk about just some ideas or opportunities you think will be in the market in terms of recaps and special situations?
Yeah, sure. So I think it's worth mentioning our Fund 5 is more of a core plus kind of pref equity fund. So that's doing deals where there's a little bit of cash flow going in. Our basis is really solid. There's not a huge lift in the business plan to get to where we think the exit value is. And then the next fund we're going to be doing is more of an opportunistic, not necessarily because of COVID, but certainly I think we're going to see a lot of opportunities because of the disruption it's caused. So it's kind of a barbell type approach where we're doing a bunch of kind of yield only pref, up to like mid 80s in the capital stack. And then on the other side of the shop, or the other side of the desk, it's more opportunistic deals where we're getting in at a basis we really, really like. And, we like the upside. So it's a little bit of a barbell type deal we're doing right now.
Yeah, since you mentioned the Core Plus, let's dive into that a little bit. I think that's an interesting program because you're looking to put pref on largely stabilized deals that you said don't need a lot of lift to achieve their terminal valuation. Mm-hmm. Why would a borrower come to JCR for such a product? Typically people are layering on a mezz or pref if they think they're going to be able to refinance out of it and, increase the value substantially. So how does your pref fit into a more core plus business plan?
Yeah, good question. So I should have clarified, not necessarily stabilized deals, but deals where there's at least a little cash flow going in. So I would say more like light value add is probably the better way to say that. So a lot of sponsors use it for deals that they think there's some lift on in terms of market rent growth or a real true value add where you're doing some CapEx or any number of kind of value add propositions. And they use it as kind of additional acquisition leverage because a lot of groups are, for the past 2012 to 2017 or 18, call it, they're used to getting, 75, 80% LTC seniors. And a lot of lenders now have pulled back proceeds to kind of 65 or 70-ish. So sponsors use it as kind of additional acquisition leverage to get back to where they're used to having their leverage point being. And then, in 2, 3, 4, 5 years, when they've added some value, they can refi or recap out the pref and own the real estate, free and clear. So that's really where it fits from the sponsor side. Is really just kind of acquisition leverage, I would say.
Got it. In situations where you're still looking to be taken out, like you said, in the 2 to 5 year time frame in that value add.
Yes. Yeah. That's how it's been working really well. Obviously, the vision is like, generally we're a little bit more bearish on mostly market rent growth and cap rates than a lot of operators are. So it allows them to kind of enhance the returns to the common equity if they are correct. And then if we're correct, they might not do as well, but we're still in a solid position. So it's kind of a, little bit higher octane deal for the sponsor. And a lot of guys like that. So it's a good product.
Yeah. I mean, if they're willing to make that bet, then you're providing them a benefit while allowing you guys to deploy capital at a basis and a yield level that you guys are comfortable with. That makes sense.
Yeah. Yeah.
And how do you guys compete? If you guys top out somewhere in the mid 80s on leverage, how do you compete with the pref shops that are putting out 90% LTC money?
So we also have that money. We do have a value add fund that it kind of sits between the two barbells I mentioned. And that fund, it goes as high as 93, 94 LTC in spots, very selectively, obviously. So we do have capital for that as well. It's just a little bit more of a tweener product that's a little tougher in this market to put out because, the classic value add business plan where we're going to put in 20 grand a door and push rents 15% is a little trickier to pull off right now than it has been over the past 8 years. So that's a good question. We certainly try to make deals work as close to the sponsor's ask as we can. And if we can't make the numbers pencil, we can just kind of ratchet down to the next, less risky product on the JCR side. So it kind of ties into what I mentioned at the top of the call here, which is like we have capital that can fit really anywhere in the stack. And it's just a matter of matching up where we see the numbers and the sponsors ask. So it's a pretty dynamic, bunch of products we have, I think, which is good.
Absolutely. Yeah. And that's a good point in terms of if you're going to go to that tweener product and step up more leverage, obviously that's going to cost somewhere in the mid-teens. And I think that's a hard pill to swallow for a sponsor to look at, preferred money that's going to cost them mid-teens where truly their project level IRR is going to be somewhere in the mid-teens also. So you'd have to be pretty aggressive to project positive leverage on top of that in this environment.
Yeah, no, you're absolutely right. And the sponsors that tend to want that preferred equity are guys who really, really believe in their business plan and think they're getting just a screamer of a buy. And, for the past 8 years, most of those guys have been correct. So we have a ton of deals we've exited where, the sponsor thought it was a 25 deal level IRR and, we beat up the numbers and we're at a 14 and we make a 14 and they make a, 150 IRR and that's fine with us. We're happy to let people make that bet. And, if it works out for them, we're happy for them. Everybody wins. So, but yeah, you need an aggressive borrower to sit behind that kind of money right now, especially.
Yeah. To that point, have you had those deals come in, across your desk and asking for pref, and have you said, well, actually the deal looks so good, we'd want a JV and we'd want to, participate in the common?
Yeah, we have. Normally what we end up doing is something kind of between those two where we do we'll go pref to a 12, maybe a little bit lower hurdle and then get a 30% or 40% kind of share of the upside. So it's a fun exercise in that we have complete discretion over the structure of the deal. It's not like we have a product where the fund docs say what we have to do. So yeah, we can definitely make that trade to the extent we like the upside on the deal.
Very cool.
Yeah.
So talking about coronavirus, are you anticipating there are some strategies or asset classes that you've been sidelined on, just given how aggressive things have, been bid up, and assuming that we go into a recession and see some price correction? what is JCR most excited to get back into that it's been largely sidelined on?
It's a timely question. We were just talking last week with our, our president and our CIO about that exact question. JCR has always been a more like situational driven shop where there's a story with the seller, and we don't necessarily have a top-down thesis in that we say, okay, we like suburban office because we think people are going to move out of urban cores because of this, coronavirus that makes people scared of density. We certainly think about things like that, but we don't necessarily design the investment strategy directly around that. It's more like we try to capitalize on opportunities as they come in keeping in mind that thesis. So generally, as it relates to coronavirus, I think we're going to see a lot of dislocation with sellers at a kind of idiosyncratic case-by-case level, and that's what we're looking for. It's not like we're going to go buy, a suburban office REIT because we believe in that asset class. It's more like, seller-specific stuff that's kind of case-by-case and goofy, and there's a partnership dispute or the lender's forcing a sale or whatever it is, and whatever that asset happens to be. We'll make sense of it then and evaluate it kind of from a blank slate. So it's a little bit more of a kind of bottom-up investment strategy, I guess I would call it, rather than top-down. That said, there are asset classes that I think we're going to see a lot of opportunities in. And I don't think we're going to aggressively pile into anything, but I think we're certainly going to see a lot of dislocation, obviously, in hospitality, retail, some office to some extent, although that's going to be a little bit slower just because there tend to be longer term leases in place. But anything that's owned by individuals rather than like sophisticated private equity institutional shops, you tend to see a lot more kind of panic selling and partnership disputes and things of that nature in the kind of middle market and smaller assets that we play in. So we're excited to see where everything shakes out once kind of this national blanket forbearance that everyone's getting right now stops and cash flows are still impaired. So right now we're just kind of gearing up, forming a thesis, and getting ready to capitalize on stuff once it finally shakes loose.
Yeah, absolutely. So jumping over to some of the other products that you mentioned, like the value add and the opportunistic joint venture programs, what is the minimum cash flow needed in year one for a deal to still fall into that value add bucket before it gets pushed into opportunistic?
Yeah, that's a great question. Generally, we say we like to see a 7% cash on cash dividend to JCR within about a year of closing. So that doesn't mean it necessarily needs to be 7 going in, but maybe you're buying a industrial property where there's some tenants with a bunch of free rent and free rent burns off, and that gets you to a 7. Or you're buying a multifamily property with a bunch of down units where you're not necessarily pushing rents right away, you're just kind of fixing the problem at the asset level and leasing up units to kind of a market occupancy. So simply the answer to your question is kind of 7. But there's a lot more distinction behind that as it relates to, how solid is that cash flow and how much CapEx are we doing and how risky do we think the business plan is in terms of execution and how nice is the property. There's kind of a lot of this nuance behind that 7.
Makes sense. So moving on to the next question, what markets are you excited about for the various strategies that we've discussed so far? And you can go by asset class, you can go by program.
Sure. So I guess I would give you a similar answer to which asset types. It's less of a top-down approach where we say, all right, we like these markets and we're going to go try to find deals in these markets. You can make money anywhere as long as you're buying at the right basis with the right partner. So generally we try to stick to top 100-ish MSAs. except for industrial, we'll kind of go anywhere it makes sense. Obviously there's a little bit of a wider net as it relates to industrial, but yeah, top 100 MSAs. And then in the COVID light specifically, I think this is not a unique viewpoint, but I think we're going to see some population and employment outflows from super dense, high cost of living cities like New York, Chicago, Boston, DC, as firms get more used to employees working from home to some extent. So, where those people go is kind of anyone's guess, but generally suburban areas of those cities and lower cost of living, secondary markets with good weather seem to be well positioned to capture some of that gateway city outflow over the next 2, 3, 4 years as people kind of get used to being able to be anywhere, or not necessarily having to live in Manhattan because your job's in Manhattan. So it's super early to tell, but the research we're doing and the stuff we're reading kind of supports that thesis. So we'll see.
Yeah. So it sounds like you're viewing the effects of coronavirus more as a catalyst exacerbating the already ongoing trend of people moving to lower cost of living, cities and states, and lower taxes, better weather, but the kind of the smile states migration.
Yes, I think that's right. And I think, like you said, that was already happening to some extent, but this has really forced companies to pull forward the next 10 years of kind of what the future looks like in terms of having a somewhat dispersed or distributed workforce and maybe a network of smaller offices rather than a couple huge offices in gateway cities.
Yeah. So given that you guys are so bottom-up focused, situationally focused, I'm imagining the answer to this might be limited, but are there any no-go asset classes, no-go markets?
No, but I will say, we think it's early for hospitality. We think we're going to see some stuff that looks like screaming bargains, over the next couple of years, again, as forbearance stops and maybe cash flows are still not what they used to be. So, obviously there's going to be a lot of opportunity in spots. But we're definitely, we try to be market agnostic in that, like I said, what really matters is, did you buy the property right with a business plan that makes sense and underwriting that makes sense? Not necessarily like, are you in the 25th biggest MSA or the 40th biggest MSA? The only markets that I think we're really, really careful on would be super energy focused markets. Obviously Houston's tough. Some other markets like, Oklahoma City from an office standpoint would be tricky given the level of occupancy for energy companies in that space. But it's not like we wouldn't do a deal there. We would just, be very careful about underwriting any kind of value add and making sure that our rent assumptions are super conservative so that we can offer the best deals to tenants that do stay. So if Oklahoma City office occupancy went down to 60%, we're part of the 60. We're not part of the 40 that's empty, right?
Yeah, interesting. So let's see, where was I getting at with that? Taking the, forgot what I was going to say. All right, next question. So at what stage do you /JCR like to receive deals, from the pre-LOI all the way to already under contract? Where does JCR best get involved?
Yeah, good question. So it depends. Generally, we like to do business with repeat kind of programmatic sponsorship setups. So for one-off deals, that's just kind of through a capital markets broker. Obviously, it's tough to invest a ton of time before the deal's really tied up. So generally, that type of kind of marketed equity we see once it's already under contract. But that's not how we like to do it. We like to form partnerships with groups that we know we like, that do deals that fall within a business plan, an asset type that we know we like. And then, set up kind of even if it's an informal programmatic thing. And then we can get involved a little earlier on because we know we understand each other. We know generally what the economic terms of the JV look like. We understand how they see the world and how they underwrite stuff. And then in that case, I certainly like to get involved, during kind of the LOI stage. Like a lot of partners will say, all right, we're looking at this building and here's our underwriting, here's where we think we're going to offer, here's as high as we would go on the purchase price. And I can kind of give the numbers a sniff test early on and tell them, yeah, I think that would work. Here's what the structure would probably look like. So they can incorporate that into their underwriting. And we're not starting from scratch when they sign a PSA. And then everyone's, in a mad scramble to get there. So I know it depends is kind of the lame answer, but definitely, again, with kind of the programmatic repeat partners, it definitely helps to get involved pre-PSA, pre-purchase price finalization.
Yeah, so you brought up a good point that I wanted to ask about, which is, in JCR's tear sheets, there's often mention of programmatic relationships available, and you kind of alluded to what that exactly means, but talk a little bit more about either, casually or structurally what that means.
Sure. So normally what it looks like is we'll sit down with the sponsor and say, let's look at your pipeline. How much do you expect to buy over the next 12 months? And what is the equity need to do that, right? So generally it's like 15 to 30-ish million of kind of equity, soft committed to a facility, we call it. And the facility will say, essentially this joint venture that we're forming gets a right of first look on everything that fits the parameters of what the facility is intended to do. So for example, we have a partner who buys a bunch of kind of big box industrial throughout the Midwest. So anything that they're looking at, we would say, they would show it to us first and we would say, yeah, this fits the terms of the facility. We like it. Let's do it. And that way we don't have to reinvent the wheel where we negotiate economics and do the joint venture docs and all that stuff every time. It allows the sponsor to run around and bid on deals maybe with a shortened diligence period and a shortened close period because they have capital teed up. And they're taken more seriously by sellers because they can seriously say with a straight face, yeah, I have the whole capital stack ready to go. It's not dependent on me raising money for this deal while I'm in due diligence. And it just takes a lot of the, uncertainty out of capital raising for the sponsor. They can focus on what they're good at, which is buying good deals and executing on good deals rather than running around and trying to raise money. And then it's good for us, obviously, because it aligns us with a group that we know we like and a strategy that we know we like. And we kind of have again, right of first look into their pipeline. So it's a really mutually beneficial setup. And we've had a ton of success. I mean, the group in the Midwest I mentioned, we're on our 5th facility with them. So, even if you fill up the 15 or 30 million, whatever it is, we can just do facility 2 and continue to do that. So it's a great vehicle to help good sponsors grow and, again, focus on the deals, not the cap stack. And again, it helps us deploy capital into strategies we like. So we definitely prefer that over, seeing a deal that's, a kind of marketed equity through a capital markets broker. And you just get kind of thrown on the matrix like a debt group would, which is fine. There's definitely a time and a place for that type of deal. But it's just a little bit more legwork to get those type of deals than it is to kind of align yourself with a good group and do the docs once and then just go execute on, 8, 10 deals.
And these facilities that you set up, are they typically coming from the pref side or joint venture, opportunistic, or it's just always a range?
Yeah, all over the board. It depends on the risk profile of their investment strategy. It depends on how much upside they're willing to trade for, giving JCR some downside protection. So we've done everything from 90-10 common equity facilities all the way to yield-only pref facilities and kind of everything that you could imagine in between. So it depends.
So I remembered what I was gonna ask, which was we were talking about the hotels and you thinking that there was going to be some discounts and some large opportunities, which I would agree with you. In what form would you say you guys are looking most to get involved in those opportunities, whether it's on the bridge, pref, common?
It's probably, it's hard to say. I think we'll do pref and common, but I think there's kind of two scenarios in hospitality that we're going to see a lot of. One of which is kind of rescue capital. So, and that would be more like pref, right? Where you trade a loan remargin, a loan pay down for an extension on the senior maturity and maybe a lower interest rate and some waiving of covenants or something like that. And that is probably an opportunity for JCR to write a pref equity check to pay down the senior and keep everybody happy and make sure the common equity is not in distress, provide some liquidity to the deal. And then with hospitality, you're certainly going to see deals where the value has come way inside of the senior. And that is probably more like, you're either buying the senior from the lender and working with the borrower to get the deal back on track, giving them kind of a hope note. Or you're doing a deed in lieu and we'd end up owning the real estate with a sponsor that bought the note from the senior. So I think it depends on the level of distress that the property is in. And again, TBD, there's going to be a ton of different types of distress within the hospitality industry. So I think we'll do both, is I guess that was a long way of saying that.
Yeah, no, there's definitely some exciting stuff out there, and you guys could play in the note-on-note financing space there, and obviously participate on the opportunistic side in terms of the deed and lieu's. So, lastly, staying somewhat on the topic, give some example structures or the way you've put a JV deal together for an opportunistic deal.
Sure. So, what we're really focused on right now, I'll give you a couple of kind of live examples. Is to the extent we're going to leverage a deal on the equity side, we got to be borrowing against very durable in-place cash flow. So a lot of the opportunistic stuff we're seeing now is vacant. We're buying it all cash with no debt. And we may put some debt on it later for CapEx or good news money. But the buy right now is truly opportunistic in that we are buying it because we like the price per pound, not because we necessarily are going to execute a value add business plan on day one of the investment. So with deals like that, we're doing a lot of 90-10 type common equity with a couple of waterfall hurdles kind of after a 10 or a 12. And it's really kind of discount to pre-virus focused, and how are you underwriting this in light of the kind of COVID macro future. So what that's looked like so far is mostly vacant industrial deals in good locations, good bones, good property specs in a good market with a seller that just is ready to pull the ripcord. So luckily in the industrial space, there's a lot of sellers who tend to be kind of large corporate users, and maybe they don't really care how much they're selling the real estate for because they've owned it for 20 years and they've depreciated it down to zero, and they never even knew it was worth 20% more 4 months ago than it is today. So there's a lot more kind of liquidity or seller willingness to make deals in the kind of opportunistic industrial space. So we're doing a bunch of again, like 90-10 JV, and a promote structure starting after a 10 or an 11 with a couple different hurdles with escalating promotes. And then kind of on the pref side, it's usually what it looks like is either we get our capital back or before the sponsor gets their capital back, or we get a preferred return and our capital back before the sponsor gets their capital back. So it depends on how much risk, again, the sponsor wants to bite off. Right now we're doing a deal where it's, I think, capital to JCR, capital to the sponsor, and then a pref to JCR, and then a pref to the sponsor, and then we go with some kind of upside, split. And again, all of these structures are kind of bespoke, so I couldn't tell you, exactly what it looks like for a kind of market rate deal, because there really are no market rate deals right now. It's all kind of case by case. So really, again, the benefit of having these kind of closed-end discretionary equity funds is we can do whatever we think the best risk-adjusted return for that property is. And there's a lot of flexibility as it relates to what the equity structure looks like.
I think what you said was really interesting in terms of if you are going to be sitting in a common equity position, you want to be you want the leverage to be backed against durable cash flows, solid asset, and in the absence of those durable cash flows, you're going to be buying all cash, because now you have no risk of sitting behind a senior piece on less than durable or non-existent cash flows.
Yeah, we were talking about that again just last week with our president, Jay, who I thought he said it really well. The kind of business plans that a lot of people were doing, including us, pre-virus was, we're going to buy an empty building with conservative leverage, but still leverage, right? And we don't want to do business plans right now, post-virus, where our leasing velocity needs to outrun the interest reserve on the senior. And then if it doesn't, all of a sudden you're in a bad spot where you have to continue carrying the loan or pay down the loan and just make tough decisions that we shouldn't have to be making right now. So given the macro uncertainty of what the next year is going to look like, we don't want to be racing against the clock as it relates to depleting an interest reserve, which I think is prudent. So that's kind of the new world order, if you will, as it relates to super opportunistic stuff where there's not any real good durable going in cash flow.
Yeah, that's I think that's definitely wise, and it's an interesting point because I actually read all of Jay's publications going back to 2006 in terms of just his take on the market and all this stuff. And it was really interesting to hear his thoughts at the different parts of the cycle and things like that. And so one thing he said was interesting is when you've got these huge dislocations and the distress, you need to start underwriting deals to an unlevered return that would be equal to a levered return in the pre-crisis state. So if you were solving for like a 15, 20, levered, now you need to go out there and get that on an unlevered basis because you just have to assume financing is unavailable or unattractive, kind of like how you described.
Yeah, it's not even about the unavailability or unattractiveness of financing necessarily. It really is just about the fact that we don't want to be borrowing against a cash flow that's not there yet. But yes, to your point about Jay's kind of macro correctness over the past 20 years, he's been really good about being on the right side of every kind of major ebb and flow in the macro economy. And luckily, pre-virus, we were in a pretty conservative place in our book. We were doing a lot of preferred equity, ratcheting down how high in the stack we were going. And today, most of our book is preferred equity in multifamily and industrial. We have one retail deal that we're preferred in. We have no hospitality, just a few office deals that, again, I think we're preferred in all the office deals that we're in right now. So, I'm not going to sit here and tell you anybody saw the virus coming, but, we were in a really well insulated place in the stack in most of our product types. And then within the product types, again, multifamily and industrial, I think the cash flows have held up very well. And, even our one retail deal, it's a grocery anchored deal, and it's going pretty well as it relates to, the rest of the universe of retail. So, it's great to have those, Jay and his partner Marin's macro expertise on our side, because a lot of the younger guys like us, we may not have been through, a significant down market before. And it's helpful to have, that kind of perspective that those guys lend to the investment thesis. And luckily they've been, pretty dead on. So it's been, I think we're going to come out of this in a pretty good spot.
Absolutely. Last question is, how does JCR bring value to deals after they've been closed?
Yeah, no, I'm glad you asked that. We service everything in-house. It's a super high touch setup. So we have a dedicated asset management team that sits in the office 20 feet away from the investment team. So we can do a lot. I mean, it's a constant dialogue between our operating partners and the asset management team and the acquisition teams. And, we have our finger on the pulse of the market, I think, in a way that a lot of sponsors don't, in that, within our equity book, we have something like 100 different investments that we're managing right now. So we have real-time data from a ton of different deals that we can kind of incorporate into our view of what to do. And then, we also have kind of more sophisticated ability to analyze tenant credit and lease terms and kind of help our operating partners make the right decisions as it relates to what to do with the asset at a very granular level. And the Todd Tilzer, who runs our asset management program, has a great background in kind of workouts and distressed paper, and as do Jay and Aaron. So between the three of them, they have seen it all and they've done it all. And really, they have a very kind of long-term informed perspective of how to work on assets that have gone sideways a little bit. And then to the extent everything's going great, awesome. We'll sit and watch from a distance. But yeah, I think really when we add value is when things start to go sideways and we can kind of help stabilize the ship and, talk to the lender and figure out what we need and, really intensively asset manage the property back to a point where, not only we're in the money, but the sponsor is also in the money. So it's a very, close kind of day-to-day collaborative relationship with our equity sponsors, which is awesome. That's why we have so many repeat sponsors that we do a lot of business with, because it's a true partnership. It's not like we're going to write a loan and then sell the servicing rights to some guy and, the sponsor never deals with you again. So it's definitely part of our value add that we pitch to guys. Very
cool. Yeah, it's definitely nice to have a partner that when you have a question or things are going sideways, like you said, they don't just call you up and say, "Where's my money?"
Yeah, exactly. And if things go really sideways, we have the financial wherewithal to pay down the loan and do what we need to do to preserve, again, not only our capital, but also our operating partners' capital. So it's, that's kind of JCR's pitch is we don't lose money on equity deals. And Jay and Aaron's track record is incredible. And I think sponsors value that because they know if things go sideways, we're going to be there to, not only write a check to kind of right size the loan, but also, help them work out what to do and how to negotiate and all that good stuff.
Well, Taylor, thanks so much for having a great discussion. Great questions, great topics. Thanks so much.
Yeah, no, it was great talking to you and appreciate the time and hopefully we can find something to work on together.
Absolutely. And if you want to, let people know how to reach out to JCR, if they're, a sponsor, borrower, you can do so.
Yeah, of course. The JCRcapital.com, my contact info is on the website, and I'm happy to screen any debt or equity opportunities that anyone thinks may be a fit for our programs. And, get back to people quickly is kind of how we try to operate. And, again, it's a brave new world, and I think we're excited to see what manifests itself in terms of new opportunities. So we're open for business and ready to rock.
Sounds good. Awesome.
Great.